We want to dig right into it right now with Marianne Bartels, who is the Chief Investment Strategist at Sanctuary Wealth. Also, Stephen Parker, who is the head of specialized strategies at JPMorgan Private Bank. And Stephen, let me just start with you. We're watching yields open up pretty sharply lower. Obviously, it's had 3 days since we've seen trading, and there's a lot that's happened in the world. Do you think that we're looking at this kind of rush into treasuries at this point because of the geopolitics and what's happening around the globe, particularly in Israel? Or do you think this is more a situation of all the Fed speak we've gotten where they say the market's been doing its work for it?
I think the knee-jerk reaction was geopolitical, but I think that the Fed speak is what's going to ultimately drives the direction of rates. It was interesting because yesterday U.S. fixed income markets were closed, but you could watch the Treasury ETFs trade. And they rallied early in the day post the terrible news this weekend. But it was really the dovish comments that you saw from some of the Fed speakers that got that rally to really kick into gear in the second half of the day.
Okay. Marianne, how about you? I know you've been preparing for higher for longer. I don't know what that means for your portfolio, but maybe first take a look at this with things pulling back. Where do you think this all settles out?
So in terms of interest rates, I 100% agree with your guess that originally the horrible events over the weekend were the initial driver of the move in rates. And I think some of the Fed speak is deliberate because we don't know what direction this is going to take. We could have treasuries being used as a flight to safety now for a period of time. It is possible that we've reached an intermediate top. And certainly if we get very good inflation data this week, that's going to help rates. What we mean by rates being higher for longer is that we're normalizing. We're not going back to that zero bound. We're going to be in a higher interest rate environment in the years to come. But that's going to fluctuate over periods of time. You're going to have periods where rates are going up and periods where rates are going down. And if we have reached an intermediate top for rates, this is actually going to be bullish for the equity markets. The only negative that we see potentially for the markets is if crude would break above 100. I think if you get crude above 100 and sustainably above there, it might impact equities negatively. But, you know, we're still in this correction. We still think we can.
Just because you think, wait, let's just run through that. Because you think it slows the economy significantly, or because you think it ends up playing a force on inflation beyond just core inflation as it works its way through, and that forces the Fed to raise rates again?
I think it's both, Becky. You know, higher crude oil prices, hurt earnings. And at the end of the day, that's what the market's going to respond to. But it's also going to hurt the consumer. So it's higher energy prices, sustainably higher energy prices, especially if they spike. You just can't respond that quickly. So it has a negative impact.
Stephen, you talked about the knee-jerk reaction in treasuries. Equities didn't even have that. Equities were up yesterday, which is a little surprising when you consider all the events of the weekend. I guess the market at this point is assuming that this is going to be contained, that this is not going to be something that's continued, or is it just too hard to figure out, so you put it in the too tough pile?
Well, I think it is really tough to anticipate where this is going, but I think history also gives us a pretty clear roadmap on geopolitics and the impact on markets. Typically, you do get a quick knee-jerk reaction, but markets quickly tend to pivot back towards fundamentals. And so I think that while there'll be an eye on what's going on in the Middle East, particularly if, as Marianne said, there's some contagion in the oil markets, I think the focus is going to shift back to the Fed. It's going to shift to earnings that are coming up this season. And I think that our view is that the earnings outlook looks good. We think we bottomed out last quarter. We begin to reaccelerate, and the fundamental story is a good one, which is supportive of stocks.
So you don't think there's any sort of a hard landing coming, that this is the economy is going to look okay throughout all of this?
We think we're going to get a soft landing. We think growth next year is going to slow, but not to the point where we see a major recession. And we think that that's going to take the pressure off of inflation, take the pressure off of the Fed, and ultimately be a good thing for equity markets. We think we make new highs by the middle of next year, driven largely by earnings growth, not by valuations, although the sell-off recently has given us a little bit more of a cushion on the valuation side as well.
Marianne, you agree with that?
I actually do. And I think what we're not talking enough about is if you look at the ISM manufacturing data, it's actually improving. Now, we're not above 50, but it looks like manufacturing has actually bottomed. Inventories are low. They're going to have to be rebuilt. and prices paid are actually falling. So it's really a positive mix now, we think, in manufacturing. We think that's going to help boost earnings. And even when we look at margins, we still think that companies can actually improve their margins. So we do see a better outlook for earnings next year. Again, as long as, crude oil doesn't spike higher and stay higher, we think the outlook for the market remains very robust. And I would agree that we can reach new highs next year in the markets.
All right, Stephen, if you think that's the case, where are you telling people to put money? I guess you think that this pullback is an opportunity.
Yeah, we've been saying that. We think this pullback is an opportunity where we remain focused on the U.S. We like the story within industrials, where we think that there's a lot of longer-term policy support for the industrial story. We're also talking about taking a look at equal-weighted S&P exposure in mid-cap names. We know that a lot of the rally this year has been driven by the Magnificent Seven. We think that there is a catch-up trade more broadly across the market, so we're moving down the capitalization spectrum a little bit. Not all the way down to small cap, because higher rates have a bigger impact there,
Sure.
But we do like the mid-cap story.
So the technology story, you think that's been overplayed to this point, just with the Magnificent Seven, what's happened with AI?
I don't think it's been overplayed, and I think there's certainly a long-term story there, but I think that what we're looking for is a little bit of a rotation in terms of market leadership away from the concentrated leadership of the mega-cap tech story to some of the broader parts of the market.
And Marianne, how do you play this? If you're a strategist, what are you telling investors right now? Where's the best place? And would you keep any money in cash right now, or you would deploy pretty heavily?
Well, in terms of cash, our clients have just been flooding into cash because they haven't had a return. Yeah, I mean, they just want to have that income. I'm not even sure I could stop them if I recommended not to go to cash, to be quite honest with you. It's been such a strong inflow. But to us, technology is the leadership of the market. If you're going to continue to have this secular bull market, you need to continue to have the leadership in tech. And amazingly, tech is still outperforming on a relative basis in this decline. So that tells us technology is going to continue to lead us out of this. I think you have to own tech. We've really been focused on semiconductors and software and services. And I would also agree that industrials are the emerging leadership, and we also continue to like energy stocks.